The Reserve Bank will make its latest rates call this afternoon, but widely expected to keep the cash rate on hold at 4.1%. There will be much dissection of the words that Michelle Bullock uses, though. Joining us is the Chief Investment Officer at the Motley, Scott Phillips. Scott, good to see you again. Rates on hold, yeah?
Yeah, Pete, almost certainly. Good morning. Middle of the election, it makes it tough, right? A couple of things that the RBA will be thinking about. The first is tariffs. You're just talking about that. The risks to the US economy and the global economy will weigh heavily on the RBA board's mind when they meet. Well, they've already met yesterday and they're meeting again today. The other one's the unemployment number, mate. It's sat still at 4.1% as a percentage, but we lost 50-odd thousand jobs last month. So if they were of a mind to cut or concerned about it, those are the two things they'll be thinking about. And then, of course, there's the politics, right? If they don't cut, someone will say, oh, they're trying to help the Liberal Party. If they do cut, someone will say, oh, they're trying to help Labor. Let's be really, really clear. The RBA is independent and non-partisan, no matter what people think, particularly the conspiracy theorists or those who are trying to push a political barrow. I wouldn't rule out a cut today, but it's not the most likely outcome. A hold, probably a clear favourite.
So what are the markets at the moment? What are the latest numbers? In terms of a cut, I mean, I know it's widely expected, but when you say you wouldn't rule out a cut, I mean, that's interesting.
Well, I mean, look, May is the hot favourite for now. The market's picked up to 3 cuts this year over the rest of the year. So next month is most likely. Firstly, because the RBA said, hey, one, but we're going to wait. So they've telegraphed the fact they didn't want to go twice in a row. We also know that, of course, there's not that much room. As much as we are used to having, or we were used to having 2% fixed rates way back in 2020 and 2022. The reality is neutral is probably 3 point something. Now, that doesn't give them much room to cut. So probably, well, again, who knows what's going to happen. The market reckons up to 3 more this year, first next month, the middle of next month in May, May 19, May 18. That's the most likely outcome if the market's right. As I said, this becomes a bit of a self-fulfilling prophecy, or at least, we all tell each other, we know, everyone thinks, oh, they say it, so I must believe it. And then, we get more certainty than maybe is deserved. As I said, the RBA has told us they don't want to go this month. It'll only be those changed circumstances, tariffs and unemployment, that do make them go if they weren't going to otherwise.
That's interesting on tariffs. I mean, Trump's calling it Liberation Day, whatever. But it will be damaging to those businesses that are caught up in this. And I guess it's just a question of how much, say it's our farmer or whether it's our beef or agriculture or whatever. If it's at 20%, it'll have a huge consequence, right?
Yeah, and mate, not only that, but there's also just the bigger impact of tariffs on the US economy more broadly, and therefore the world economy. Remember, the Atlanta branch of the US Fed was predicting a recession in the US effectively on the back of this. Their forecast dipped very deeply and steeply. Plenty of economists now coming out saying the US is headed for a recession. Why? Because prices are going to go up for imported and therefore domestic goods. That's going to have an impact. So if that is to happen. So there's the direct tariff impact, as you say, aluminium, steel, potentially agriculture, potentially pharmaceuticals, maybe just the broad countrywide tariff. But it's not even so much that, mate. I mean, if there is a countrywide tariff that's going to really hurt trade, it's more if there is a US recession or a US downturn. We know the US is the world's largest economy, they're the world's largest consumer economy by miles, and so the ripple effects of a US downturn or a US recession will be significant. Well, we may be able to avoid a recession, but no guarantees.
Oh, well, okay, on that point, because, I mean, Jim Chalmers and the lot, they've been saying we're in for a soft landing here, but if the US heads into recession, then I was just going to ask you, does that mean we will too?
Not necessarily, but very possibly. So we shouldn't rule this out. I'm an optimist by nature, Pete, that. But let's also be real about what's going on. The Atlanta Fed's actually predicting an economic decline of about 2.3%. I think was the last number I saw. Now, that's a massive recession. I mean, it may not last particularly long because it is tariffs, it's a one-off impact. Hopefully for them, hopefully for us, it's a relatively short-lived problem. But yeah, I mean, it could hang around. Think about economic output being reduced because of tariffs. It takes a year to cycle on last year's numbers. So we could be looking at a 6 or 12-month recession in the US. If that happens, the simple reduction of demand out of the US, not even directly, just the fact that they're buying less, they're spending less, therefore they're going to buy less from overseas, that does filter through the economies in general.
Nice one, Scott. See you next week.